Hey everyone, welcome back to Yuri's Box. In this video, I'm going to talk about TLT, looking back at history. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. Now, the point of this video is really to have and make some dubious speculation if you want to draw a parallel towards Benjamin Cowen's videos which I thoroughly enjoy and I suggest you follow if you don't already follow him on YouTube, and really point a similarity that I've been tracking for quite a bit. Now, this isn't to say that I'm advocating for things to play out exactly as they have in the past. It's just a fun little tidbit to consider. Now, to keep things simple, I won't be looking at TLT. TLT as an ETF tracks bonds with a maturity greater of 20 years. So if I'm not mistaken, the average maturity currently in TLT is somewhere between 24 and 25 years. It is really an average between the 20-year yield and the 30-year yield on the for US Treasuries. So to get to it, I'll be looking at the 30-year yield chart as opposed to the TLT's chart. And the place I want to start is the end of 2021, beginning of 2022, where we saw the first run up in rates on the 30-year bond, followed by the first rise, followed by a significant decline, which eventually resulted in another rise in the 30-year yield, which was followed in turn by a holding pattern. Now, this holding pattern right here was a result of bond market participants really pricing in the possibility of rate cuts. All the while, the Fed was hiking rates. And the reasoning behind, expecting rate cuts was that, yes, the Fed had hiked rates a lot, but it hiked rates so fast and such in a dramatic fashion that it was bound to break something. Therefore, a recession in 2023 was to be expected, and so subsequent rate cuts. Of course, after that, what we saw was really the bond market playing catch up. And this really, if I wanted to go off on a tangent, really speaks. It really says a lot about we like to think that the bond market has smart money, but as opposed to the stock market. But if you really go on look deep down, really the bond market has gotten a lot of things wrong, especially in this cycle. If you had to go off of what the bond market was pricing in, you would have been off sides many, many times. And I can tell you because I was one of those people. Okay. So, listen to the bond market, but, don't think that, there are people in the bond market investors are all Einsteins, okay? We all have our faults. In any case, this holding pattern that we saw end in the summer of 23 resulted again in the bond market having to play catch up to all the positive economic data that we had, resulting in the October of 2023 high at nearly 5.1%. After that, we saw really this W formation. Okay, I think I've seen it being called something like a shark pattern or something like that. In any case, you get the idea. This is kind of what we've had this cycle. Now, the parallel that I'm going to draw is to the 2006-2008 cycle. Now, I want to get one thing clear before I go any further. I'm not advocating for canned tuna and a bunker and canned corn. I don't think we're going. I mean, I'm not expecting a 2008, repeat. All I'm saying is that, and as I'll explain, there are a few similarities to that cycle in particular. Now, going back to today's chart, as I pointed out, we saw a first rise, which you can identify in this rise here, followed by a decline. Okay, this would be these two moves right here, followed by another run up in rates, which in turn was followed by this kind of holding pattern, which resulted in the first major high. Okay, so I really have 1, 2, 3, 4, and 5. 1, 2, 3, 4, and 5. Okay, the last final run up. Now, the first thing that jumps out is that at best this is a stretched out version of what we saw in 2007. Now, this could be because of money printing and cycles becoming longer. Whatever the reason is, at least to me, and again, this is dubious speculation at best, as Benjamin Cowan would say, if I had to draw a parallel, this is what I would draw it towards. Okay. After this is what we saw is a W pattern, which eventually broke down following the events that we saw in 2008. Now, this kind of parallel was very popular. I saw a lot of people catch up to it, especially during October or November, given the fact that in 2007 and 2024, the Fed started cutting rates on the same day. We had the first rate cut being a 50 basis point rate cut arrive on the day of September the 18th, if I'm not mistaken. Now, the first big divergence between the two cycles is that, of course, by January of 2008, if I'm not mistaken, we had something like 100 basis points of cuts by the Fed. Of course, we didn't have that this cycle. By 2008, in January of 2008, things were already looking, iffy at best. Okay. So that is one major difference. Again, you could argue that we might get there at a later stage. And again, I've argued many, many times that being bullish on the 30-year yield is really a story for the summer. It's still playing out, okay? But in order to make the case for the similarity between this cycle and the 2008 cycle, you really need something more. I mean, you just can't go on, and draw a couple of squigglies on a chart and call it a day. The biggest I see really two similarities. One is stronger, and I think is the best place to start, which is the inflation story. Okay, I've highlighted the peak in inflation in 2008 in July at 5.6, which you can see right here on the chart. Now, while it is true, we definitely don't have a 5 handle on inflation this time around, which is welcome news. Nobody wants to see, prices break out. The narrative is quite similar. And what do I mean by that? Because of the run-up in inflation we saw in 2020, from 2020 to 2022, what we have developed ever since then is a form that I like to call of inflation PTSD, meaning that after 2022, priority has been the fight against inflation. And again, for good reason. I mean, we've had economic surprises being positive, and really not much of a reason to worry about the growth side of things, okay? So, but at the same time, what we do have is ever since the Fed started cutting rates in September, again, this form of inflation PTSD take place, and kind of the unwillingness to at least acknowledge some of the uh, warning signs. Now, granted, things have changed in the last month and a half, but again, the bias between growth or inflation has been towards inflation. You know, we continue to look for reasons to be afraid of inflation, whatever the case. And that is a parallel that I find with 2008, really. And again, that is really a healthy exercise, in my opinion, just to remind ourselves that yes, every cycle is different and nothing will, repeat the same way. But what we're seeing today, although it is incredible and it is, has a huge magnitude, it isn't necessarily unique. Because again, while we don't have a 5 handle inflation right now, what we do have is, at least until, a month ago, we really did have a lot of what was being said back in 2007, 2008, where even while we were smack in the middle of, development of the 2008 recession, we had many articles, and, just look them up. It's a very fun exercise to do and read what people were calling for during this time frame, and you'll find that people were calling for the exact same things they are calling for today: no more rate cuts, and the rate cuts that we've put in place so far have done nothing but be a tailwind for more inflation. Okay, and keep in mind, in 2008, by the time inflation was at 5.6, we had already had Bear Stearns. Bear Stearns collapsed in March of 2008. And 2 months later, we had Lehman Brothers collapse. And inflation was at 5.6%. And a lot of people, like today, were paying a lot of attention to the inflation side of the story. Okay? That is the first real big parallel I can find that adds weight to the comparison between the move that we saw in 2022 up until today and the move that we saw from 2005 up until, the recession of 2008. Now, one thing I want to stress is that, contrary to what a lot of people believe right now, I don't think we are currently in a recession. The best way I would characterize current affairs is a slowdown. What we've seen so far is consistent with a slowdown, and we've had many reasons for that. We've had, generally speaking, first signs of it in last summer. A lot of things kind of mudding the water ever since September up until now. And now we're kind of trying to figure out where we are, really. The second clue comes in the shape of the quits rate. Now, I have argued many times for the quits rate and why I like the quits rate in particular. And I'll explain it briefly now, is that the way I treat the quits rate is I treat it like a survey. Its biggest competition is the University of Michigan survey. But between the two, I prefer the quits rate. And for the simple reason, and the reason is quite simple. If you look at things like the University of Michigan, and this is keep in mind, this isn't this month's release, this is the last February's release. The problem with any survey, okay, is that if you ask for people's opinion, you're going to get a lot of noise. And the noise is really political leaning. And really the best example, the best way to visualize this is inflation expectations. Ever since the election, you've seen inflation expectations for Democrats soar, And inflation expectations for Republicans basically expect price and deflation. Okay. And again, if you're asking for people's opinion, their opinions will be skewed by political leanings. On the flip side, the quits rate eliminates all of the noise, because the quits rate really, in my opinion, is a survey of people's actions rather than people's beliefs. And the way the quits rate works really is, if you are at cycle highs, like here, what people are telling you is that they see abundance in the economy in the shape of many job openings. So the fact that you have a lot of job openings means that you have leverage, because if you have another job that is offering you more, or you can go to your boss and say, Mr. Bossman, fork up a 6%, 7% rise in my wage, or I'm switching jobs. And so whenever you're at cycle highs in the quits rate, that is typically associated with a labor market that is an employee's labor market. When you're at cycle lows in the quits rate, that is an employer's labor market, because employees no longer have that leverage. And because they no longer, and the reason why they no longer have that leverage is that they no longer see abundance in the economy. They no longer see many job openings. And so what people are telling you with a low quits rate is that I'm going to keep my job. I'm not going to act in an aggressive manner because I don't see abundance in the economy. Therefore, if I were to lose my job, I wouldn't be so confident that I would find a new job. So I'm going to stay put, and I'm going to, be happy with what I've got. Now, coming back to the 2008 cycle, really, this is, you really have to kind of, this is really the most dubious part of the parallel, really. While you did see first run up, okay, to the first high right here, you saw the quits rate stall, have a first downturn, and then eventually resolve to the downside following the 2008 recession. Now, if I had to find a parallel between now and 2007, the biggest comparison I would say is between where we are right now and the levels we see right here, that are equivalent to basically August of 2007. Okay, we are exactly at the same spot that we were in August of 2007, if I'm not mistaken. 1.9, something like that. Yeah, well, more or less. Okay, we're at these levels right here. And the reason why I think, if we want to keep on playing with this parallel, is because where we are right now on the 30-year yield is we are really backtesting the bull market support band after this first decline in the W formation. So right here, and we are right there. We're backtesting the bull market support band. If you go back to August of 2007, right here, that is where we are on the quits rate. Okay, we are at the same level on the quits rate where we were on 2007, with kind of the same move on the 30-year yield. A backtest of the bull market support band, and the quits rate really at kind of the similar levels. If this is correct and it plays on a similar fashion, the immediate implication of what I'm saying is that we are likely to see further downside in the quits rate, which would be consistent with further slowing in the economy. Now, this really is just, is up for debate. And, the only thing we can do really is wait for incoming data, whether, and confirm or dismiss this setup. So really, if I had to say where we are, looking at the 2007 cycle, I would say we are right around August of 2007. Okay, just drawing a parallel between what happened last cycle. Now, again, things play out. Each cycle is very, very much a story of its own. Again, I can find many things to pick on this this parallel, and I'll do it right away. The first big difference you see is that we didn't have a sweep of the first high. And if you actually go to the chart in TLT, this conflicts with, one of the things I've pointed out many times. The reason why I have this white line I've pointed out many times is that TLT and, the long end of the curve likes to put in double bottoms. And there are two ways it really puts in a double bottom. The two examples I've pointed out in my previous videos are the 2006-2008 cycle style of double bottom, where you see a sweep of the previous low, or the 2010 double bottom, where you see a higher second low. Now, this time around, you haven't seen the sweep of the previous high on the yield, which again, you don't see the secondary low. Now, just to dismiss everything I've said in this video, as I've said many, many times, the place where we are now in the economic cycle, as far as I'm concerned, isn't a place where you want to put a lot of faith in technicals, bear flags, bull flags, fib retracements. It all comes down to the data. Because, again, we still haven't retested or swept the previous low in TLT, which is this first high on the yield so far. And the two very important words are so far, because say next the non-farm payroll print comes in something ridiculous, something that no one is expecting, say 300K. 300K would throw a huge wrench into the slowdown theme, and could a retest or a sweep of the previous low be in the cards? Of course. If, on the other hand, you continue to see this, continue to see economic data surprise to the downside, you make the case for a slowdown stronger. And so it just makes the case for a possible repeat of what you saw in 2007, where yields continued to move towards the downside. Okay, again, as I've said many, many times before, we really are in a place where we are being held hostage by economic data. That will determine whether what we're seeing now, this backtest of the bull market support band on the 30-year yield, is the same indeed as this backtest as we're seeing right here. If economic data surprises to the downside, then you can definitely come back in this video and say, the case was strong. If you see economic data surprise to the upside, then this was all for nothing, and we had a good half an hour. We had fun. Okay, so again, going back to TLT, if you do see economic data surprise to the downside, then of course yields will continue to move lower, and TLT has blue skies ahead. So really, pay attention to economic data. Honestly, I wouldn't be surprised if we see something similar, given the fact that we do have, as I've pointed out in my previous videos, some factors that could feed into the slowdown story, mainly tariffs, government layoffs, and a slowdown in government spending and state and local government spending. and as well as the added bonus of put in a little sprinkle of yen carry trade. You do have factors potentially acting as a tailwind for lower yields, but again, that is all to be seen. So just to bring everything home, what I've pointed out is, again, these 5 moves we've seen in this cycle be a stretched out version of what we've seen in 2007. Again, I'm not arguing for a repeat of 2008, and honestly, I hope we don't see a repeat of 2008. However bullish for bonds, I would much rather not live in a repeat of 2008. But in any case, you do see things that are play into this comparison, like inflation. The inflation story. You see the same narratives take hold right now, like in 2008, where you had many people, scream for. I'll scream. I won't be so dramatic. Just argue for the rate hikes because inflation was a big problem. And while we're at it, it is very, very popular to say that the Fed made a mistake in September with its 100 basis point rate cuts. That being a possible Fed policy mistake. I'm not so convinced it was a mistake, because I simply believe that whatever choice you make when it comes down to setting interest rate policy really takes time to play out. I don't believe that if you cut 50 basis points or 75 or even 100 basis points, you have 100 basis points of rate cuts, they have an immediate effect. Okay. It takes time. Okay. Whatever you do now, you're really affecting the future. No, you're not affecting the present. So I would be cautious when it comes down to, saying whether what the Fed did in September is a mistake. I have a feeling that, looking back, again, this is just my feeling, I could very easily be wrong. But again, my general feeling is that we'll look back and say that they should have done more, which is something that is quite consistent with history. If you look back, that is exactly what happened, like in the 2008 recession. Again, will this play out? I don't know. I haven't got the slightest idea. I'm not advocating for it. I hope it doesn't happen. The only thing that will confirm it or dismiss it, again, is the economic data. Already next week we have an important, really tomorrow we have the FOMC, which could definitely move rates one way or the other. But what really will determine the next move, I think, is really the non-farm payroll report, as well as next week's release of the S&P PMIs. Okay, if you continue to see further clues that we are indeed in an environment that is more consistent with something like last summer, okay, so when at a time where we were reconsidering growth prospects, then bonds have more to run, a lot more to run. If, on the other hand, you see data come up on the positive side, it just reinforces the idea that maybe what we saw in February was just a fluke, and the economy is holding much, much better than we anticipated. Again, it all comes down to the data rather than technicals. Again, I'll leave it at that. I hope you can find some value, at least in this video. If you like this kind of content, consider leaving a like, and I'll see you in the next video. Bye.